Explainer 13, Trade and Current Account. Hi, John Rothfield with Derivative Logic. So tariffs. Tariffs are a highly regressive tax on consumers, falling disproportionately on low-income consumers. They are unsurprisingly unpopular with voters, but consistent with the new US administration's unwinding of what they saw as a globalist trade system that had willfully harmed the homeland. The US's return to a high tariff regime in 2025 arose from what I consider to be a fundamental misunderstanding of why trade deficits exist with the rest of the world in the first place, as I outlined in the explainer on the twin deficits. That the US external deficit is not the result of unfair trading practices, but ultimately the shortfall between domestic savers and domestic spenders. The jury is still out on how this pans out in the long run, but we do know that the US trade deficit with the rest of the world was unchanged in 2025 versus 2024, despite a sharp rise in tariffing. How do we know this? We know it from the monthly report from the Bureau of Economic Analysis, which is entitled International Trade in Goods and Services. The US has a small surplus in the trade of services. This area includes travel, education, entertainments that we export, but an overwhelming deficit in the trade of goods. To get a clean read on the trade balance, one has to subtract trade in non-monetary gold, which is regarded as speculative. Once that is done, the data show that the US trade deficit in goods and services was exactly $900 billion during 2025, unchanged from 2024. Were there any silver linings in this report? One was that toward the end of 2025, the US deficit on trade in pharmaceuticals had begun to narrow a little, although it's too early to tell whether this is a trend. A second silver lining was that because of the AI boom, the US deficit in computers and peripherals widened significantly during 2025. Imports of goods for investment are fundamentally different to those for consumption because the former can generate a future return. Now, to complement the monthly trade report, there are two quarterly reports from the Bureau of Economic Analysis, BEA, that measure shifts in the US's external position in general. One is a report called US International Transactions. It measures quarter-to-quarter flows. The other is the US International Investment Position. This measures outstanding assets and liabilities at the end of the quarter, so it's a stock concept, and it includes market-to-market valuation effects. The transactions report shows that the United States had a current account deficit that exceeds the trade deficit. The main difference here is that the US is a net exporter or a net importer of foreign aid, remittances and insurance. There is also some net US investment income paid to foreign holders of US assets. For example, in 2025, the US current account deficit ran at a rate of around 1.1 trillion versus a balance on goods and services of about 900 billion. So who are the funding countries for our current account deficit during 2025? The countries with the largest surpluses were China, the Euro area and Japan. Their surpluses added up to about $1.2 trillion, offsetting the US deficit. These countries mean that the US has a net incremental funding requirement each year, and a lot of that funding requirement comes through China, the Euro area and Japan. Circling back to the flow of funds, there is little reason to expect that the US's dependence on foreign inflows of capital will diminish much in the next few years. In the government sector, there is minimal hope of arresting the dire trajectory in the federal deficits that began in the mid-2010s. These include an aging population, very low rates of personal and corporate tax collections following 2 rounds of big tax cuts, and expenditures made during the pandemic recession. Even without assuming wars or recessions or making recent temporary tax cuts permanent, The main judgment on these numbers is the Congressional Budget Office, which expects federal budget deficits of around 7% of GDP over the next 10 years, which by 2036 will amount to more than $3 trillion a year. There is no way that the domestic savings pool will keep up, especially during the next few years, when projected investments in the AI theme remain very elevated. Bottom line, the twin balances are right now a boiling frog, but a tail risk for a future melt-up in US interest rates because of our reliance on foreign capital. Please let us know if you have any other topics which we should be covering in our Explainer series.